Hello, my name's Dominic with Cutler Real Estate. Thanks for tuning in today. We're in almost the spring of 2022, and there's a lot of talk about, is this real estate market sustainable? Or are we heading towards a crash? Hear a lot of talk about that. Well, I'd like to get into that with you. So I have several graphs I'd like to show you to articulate what's truly going on versus what we think is going on. So first graph, worries of a housing bubble still persist. Believe it or not, 77% of the consumers believe we have a problem and there's a bubble. And real estate agents, 44%. So that's pretty scary to me. And I want to know where this is coming from. Well, part of it is headlines. Bloomberg and Boston Agent, if you look at their headlines, they think U.S. foreclosures surged January after the end of the pandemic freeze. That was February 10th, 2022. And then, of course, in January, if you look, U.S. foreclosures are the highest since the pandemic starts. Now, when you see headlines like that, this is what frustrates me about the news is, does it clarify or does it terrify? Well, let's break the numbers down. Look at the next graph, foreclosure activity at an all-time low. So if you look at the graph from 2005 to 2021, you can clearly see how many foreclosures. And of course, in 2007 to 2011, there were quite a few foreclosures, and that's what created the debacle we had in 2008. Now look, fast forward 16, 17, 18, of course, the pandemic in 2020 and then 2021. Look at how the foreclosures are at an all-time low. Now, forbearance is the next graph. So loans and forbearance are still falling. So what that means is if you were to look at foreclosures, they usually come from people that are in trouble financially. It could be the economy, it could be job loss, it could be many things. And if you look at this one, in 2020, when the pandemic happened, the people that had mortgage loans had an opportunity to get a forbearance opportunity that would work with them on their payments if they felt they were going to get behind. And you could see it's 8.47 in May of 2020, which is when the lockdowns all happened. So that was pretty scary. So if all those properties came to foreclosure, if they couldn't do a workout with the banks on their forbearances, but look at all the way to January 2022, it's dropped all the way down to 1.3. But actually, if you look here in March, it's actually down to under 1 million forbearances. So that means that pretty much everybody that was in trouble were able to work out a plan and they're back on solid ground. So there's not going to be very many foreclosures coming like it was leading up to 2008. Now let's look at the inventory of homes. It's nothing like last time. So if you look at the orange graph, it says 4 years of housing crash, right? So 2007 through 2010, if you look, that's how many months of inventory there were on the market leading up during that crash of the last time. Now, leading up now, 19, 20, 21, and 22, which is in the blue category, we only have 3.8 months of inventory in 2019, and now 1.6 months of inventory in 2022. Now, really, it's really less than that. And if you look in your local marketplace, let's say in Stark County, it's less than 1 month's supply. So what does that mean in English? Well, first of all, are we heading towards that crash that they talked about because the appreciation values are so high? Well, let's look at existing sales. They hit a 15-year record. So that means in 2019, when you look, there's 5,340,000 sales. And then in 2020, there's 5,640. And then in 2021, you had 6,120,000. So as you could see, there's a lot of activity, even though there's a shortage of inventory. So when you look at people back in 08, 9, 10, and 11, when we had the crash, one of the big issues were people that were buying homes had really low credit scores, and therefore it was a higher risk to the economy. So if you look at this next graph, nothing is like the last time. You can see that the credit score is under 620. Look at 2003 through 2007. There were 350, almost $400 billion in loans with lower credit scores. Now, since the debacle in 08 through 13, if you notice the graph to the right, the blue, look at 2021 third quarter, you could see the majority of the loans now are people with higher credit ratings Therefore, they're a little bit more stable as far as financial. Now, when you look at the worry about the crash and you see the huge shortage of homes on the market, the next graph says the impact of inventory on homes and prices. So we know supply and demand always impacts what's happening, and that's across all sectors of the market, not just real estate. So the seller's market it's been for the last 3 years, and the reason why is because we have less than 6 months of inventory. Now, obviously, when you saw the prior graphs, we have 1.3 months or less, so it's for sure favoring the seller. That's why the prices are going up. Now, the neutral market that we normally would see when things are balanced between how many homes are on the market and how many buyers are on the market is usually between 6 and 7 months. And that usually shows a nice solid appreciation, nothing too dramatic. And then when the market crashed in 08 through 13, there were a lot more homes on the market, which created what's called a buyer's market. That means if you have more than 7 months worth of inventory. So in that case, well, then it would favor the buyer. So in closing, when you look at the perception of what the headlines are saying, yes, there are some foreclosures and they'll continue to come, but not at a pace like it did up to 08 to create that crash and the devaluation like it was. Now, in looking at the interest rates, so they're talking about the prices still appreciating, possibly 10.5% this year, and they're looking at the interest rates going up now with the war in Ukraine. Everybody's a little nervous, so I think they're going to taper off a little bit for the short term. So I think the rates will hover around 3.5 to 3.65 for a little bit. And then once they get a handle of the gas prices and the inflation that's tapping 7.9%, hopefully we get that under control, because that affects the comfort zone, what you call consumer confidence. And if you feel insecure about the future, then you tend to pull back. So you want to make sure that if you're looking for a hedge against inflation, you want to protect yourself. These headlines terrify, they don't clarify. So I hope I clarified the basics to you today, so you're a better informed decision maker. If you have further questions you'd like to know more, call me at 330-418-1535. Send me an email, Dominic at dominicfonte.com. Or if you'd like to see my more than 340 5-star reviews to see what you may experience working with me and my team, feel free to check them out. Thanks for tuning in.